What's going on, guys? Brian's here. Today is Sunday, April 9th, 2023, and continuing right along with the weekly recap series, we will be reviewing the price action from April 3rd to April 6th right here. It was a short week because the market was closed on Friday for Good Friday. Happy Easter if you guys celebrate it. This video is usually released for the Quant Trading App members, but I'm releasing it to the public. So if you want to know what Quant Trading App is, link is in the description down below. These levels that you see on the chart are generated from the Quant Trading App platform. We have weekly levels here. These are referred to as the intraday levels. We also have an anchored VWAP. We have an absolute gamma strike, a positive gamma strike. We have a negative gamma strike, and then we have max pain. If these are things that you are not familiar with, I will briefly touch on them as the video progresses, but I just wanted to let you guys know that all the levels that you see on this chart are generated from the Quant Trading App platform, and none of these are drawn in manually. What we have is Monday's price action right here, but before we jump into this week, I actually want to just scroll over for a second, and this is the Quant Trading App Discord. I will be touching on this in a little bit, but this is, as you guys know, the structure in which I'll be presenting these videos. I can organize them a little bit quicker and go over a lot of very powerful, great information as the market teaches us every week. Let's just zoom right into the start of this presentation right here, and we have, this is the full recap to the week. So this is the SPX. I will be mostly focused on the SPX on the SPY. This looks a little chaotic, but we will be breaking it down. This is the combination of the Monday, Tuesday, Wednesday, Thursday script all on the chart at the same time. Whenever we're trading, it doesn't look like that. You'll usually focus on just the Monday, and then I will be able to turn this off. And when we jump to reviewing Tuesday, it would look like this and so forth. So this is generally what it looks like. The script is copy and pasted from pre-market if it's that day of the week. So if it's Monday, the algorithm would calculate all of the levels from the options chain, as well as some statistical levels, putting on your chart, and then you can trade using this information. Then we proceed to add the next day and so forth. So let's just jump over to Mila Notes, which again will be the tool in which I'll be using to present this information moving forward. So what we have right here is the SPX, but before we jump into that, I want to bring up the previous week. So this is just a screenshot from the trading platform Thinkorswim, and we had the market actually closed over 2 sigma. Now this is the end of the quarter, so this was Friday, March 31st right here. As you guys can see, this is the review from the 27th to the 31st. The video was also public on this YouTube channel, so you can go back and check what happened last week. But what we have right here is a close over 2 sigma, which is very rare. I believe one of you guys within Quant Trading App, I was very happy to see that you actually posted in the gold chat at the start of the week as you went back and reviewed what happened in the past. So let's just jump over to Quant Trading App, and to refrain from repeating it over and over for this video, I'm just going to say QTA. QTA stands for Quant Trading App. What we have is the open, high, low, close table for this year. And what we have right here is this is highlighted because it's showing that the SPY not closed, it actually broke 2 sigma resistance, and then we can see it closed above it right here because it closed at 409, and then we can see that 2 sigma was supposed to be about 408.99, so that's a break. Now that's not something that's very common. However, what we can see right here is the net change for the weekly time frame was only 20 cents. So this essentially is a doji on the weekly time frame. So let's actually just pull that up for a second here. We'll let that load, and then I want to jump to last year just so you guys can see something, because this is very important information. Again, we take the previous information from the previous week, use it because we always want to ask ourselves, where did the market come from as an indication as to where it might go? And we have data to support that. If we take a look at this right here, we can see that this is the week in which the SPX or the SPY, I'll be using them interchangeably, but the SPY, it broke 2 sigma resistance, and look what happened the following week. We can see there was a massive drop off in the net change. So it went from a 24-point net change to only 8 points. And if we continue right along, we can see that this was a breach of the 2 sigma resistance level. 2 sigma resistance level, by the way, for those of you that don't know, it's this level right up here. It's a level that's generated from Quant Trading App. So as we come back here, we can see that it breached it, and look what happened. It went from moving 25 points for a net change that week to only 4. Here it was again, it went from moving 24 points to just having a net change of 8.4. As we scroll down, we had a breach of 2 sigma resistance. It went from 5.6 to about 5.16, so not that drastic of a change, but this was already not, that big of a big week here. And then we have this right here, another breach. It went from 22 points to 2 points. So what we can say so far for just last year, we can go back to multiple years, but I'm trying to keep this video pretty short. For those of you that are in QTA, I suggest you go back and just click, any of these previous years and just look for the levels that are highlighted as purple, and then just see what happened the following week. The one thing we can see is that the markets generally has a net change that is always lower than the previous week. So just based on 2022, 100% of the time it broke 2 sigma resistance. The following week it had a shorter or smaller net change, which means the price action looked like this. So this is what I just want to pull up. We can see that it ended up closing last week. These are weekly time frames. We can see that it ended up closing as a doji. So using that information, if we know last week it broke over 2 sigma resistance, and then we also know whenever it tends to break 2 sigma resistance, the following week it actually tends to have a smaller net change. We can translate that to thinking the expectation will be that the market will be a little bit choppy as it's not expected to go anywhere. Now, as I look at this is the weekly aggregate for the upcoming week. So what we're looking at is this was generated again also on March 31st. So we're starting with last week, Friday. I'm recording this video on the weekend after the week of the April 6th, but this information here is generated on March 31st. So this would have been the Friday right here. So again, whenever the market is about to close, I suggest, or during power hour of a Friday for QTA members, I suggest you take a look at the upcoming week GEX profile. So what we're looking at is a gamma profile, and it was saying that there was a ton of gamma exposure around 4,100 for this week, the week of the 3rd to the 6th. So that's the week in which we're going to be reviewing. This information is right here within the Quant Trading App Discord, as well as you can pull it up on the website. But just to show you guys that are on YouTube that are viewing this, that are not QTA members, you guys can see that these are the timestamps here for when this information was sent from Quant Trading App straight to the Discord. So as we try to find the 31st right here, so this is April 3rd, this is the 31st, so this was the Friday. If we pull this up, this is from 12 p.m. Eastern time, and then we can see that this is where the SPX was. It was at 40.85, and it was just letting us know for the upcoming week for all of the expirations combined between the 3rd and the 6th, this is what our gamma exposure profile looked like, or our GEX profile is what I like to call it, and that's what this is saying right here. So before Monday even starts, I wanted to kind of point that out, because now if we jump over here to the Monday in review, this would be April 3rd. Coming into this week, that's what this purple levels is telling us. It's telling us, hey, pay attention to this 4,100 level because there's a ton of gamma at this level. We can see that the market opens up at 4,100. It might be a coincidence that it just happened to open at 4,100, but as you guys can see, look at where it closed at the end of the week at 4,105. That's a little bit of a preview, but imagine at the start of the week, we didn't know obviously it was going to end up closing around here. We're just trying to assess the data that we have in advance to come up with a game plan for the upcoming week. So what we have right here is the market opens at 4,100 and then it rallies into the QTA sell zone, or the intraday level right here, intraday resistance level, and then it ended up pulling back to this 4,100 level. So let's just jump forward and take a look at something that I pointed out within the Discord here. So the VIX is up. This is just a clue. This was early on Monday morning because I was just bringing it to you guys' attention. Sorry, as I just scroll back and forth. I'll show you guys if you care to actually see. This is from the my notes right here. So as I'm just pointing this out, as before price action actually got to it, this was right here. This was the screenshot, just letting you guys know, hey, we're in the intraday zone, and then letting us know that this is kind of strange that the VIX is up. So I now combined these screenshots from the Discord so to make it a little bit more organized, so I don't have to scroll around all the different channels within the Discord, but just bring it to you guys' attention. If you want to know where I might post something that's really important, it'll be in Brian's notes. I don't bombard the Discord with a ton of this. Is whenever it's something that's very important, I like to just bring it to you guys' attention. I did forget to post, however, that the SPX closed over 2 sigma last week, so we were expected a reduced net change for this upcoming week. One of you traders ended up mentioning that in the gold chat at the start of the week, and then I took that as like, oh, you guys probably saw that and was aware of what he was talking about. That's my fault. I should have reiterated that in the Bryant notes just so you guys can be aware of this information also, because I know some of you guys that work 9 to 5 or have day jobs, sometimes you miss a lot what's going on within the gold chat, and I tend to come in again and only post when it's something that's really important, because at the end of the day, I want you guys to be able to formulate these trade ideas, and that's the point of putting out these videos, so you guys can come up with these ideas, these trade ideas on your own, as well as have a firm approach to your analysis for the upcoming week or just the day or what trading decisions you're going to make. So what we have right here, what I was referring to is, again, the VIX is up, SPY is up. That's already strange, or a red flag, and then we can see we're at the intraday zone. So as we just continue right along, let's see what slide here. So this is, again, just a screenshot, just showing you guys a little bit larger. This is at 10:15 a.m. Eastern time. If we have momentum traders that are taking the breakouts over the previous day's high, they will ride it up until momentum fails. And once that momentum dries up, they're probably clocking out. Some of them are going on early lunch breaks and so forth. And then we'll have the reversion to the mean. Traders come in. And then we have, power hour. We'll see where the dust kind of settles for the day. If you've ever heard this saying, also, amateurs trade the open, professionals trade the close. That's just another famous saying regarding the stock market, something to take note of. So if you don't trade in the middle of the day, that's fine. That's something that's taught. If you don't want to trade the opening drive, you kind of have a sweet spot around here to try to trade the reversion to the mean. And then you also have the end of the day to trade maybe also reversion to the mean, usually a breakout. This is where swing traders tend to open up their positions and so forth. So just another little gem for you guys. Moving right along. We have, it ended up working out in this case here. Now, you want to ask yourself, why would you have taken a short here? Obviously, if you're a Quant Trading App member, you know this is the visual cue. We're at the intraday level. So let's just jump forward. I wanted to show you guys a little bit more confluence. This is something which I was sharing. We have the Trading Ticks Algoflow is showing some bearish divergence. So we have, this is where the SPY was at the time. This is where the Trading Ticks Algoflow is showing. So there was a massive divergence. This is a difference of about 5 points or so. So this is pretty decent. It's not, we've seen larger, but 5 points is a decent enough reason to think we might pull back. However, I mentioned that if you use the TR Algoflow for just the market, so the market, according to Trading Ticks, is showing the total flow for options, for all options in the markets, I believe the S&P 500, whereas this is the actual ETF of the SPY. So the divergence here is not going to be that uncommon because the SPY is used as an instrument for hedging. In other words, if an institution decides to buy, a few million shares of Apple, a few million shares of Microsoft, a few million shares of Amazon, a few million shares of Nvidia, they might actually sell a few, or they might actually buy a ton of puts in the SPY. So that's pretty bearish. They might buy a ton of puts in the QQQ to offset some of this risk up here. So this is why the market's net flow might look pretty green, but then the SPX net flow might be pretty red. It's because the SPY is used usually for hedging. So as we move right along, again, we can see there was divergence in the Qs, divergence in the IWM. So what we have is divergence in terms of bearish divergence is what we'll say, because the Algoflow is pointing down here, but yet the spot price is all the way up here. So that's bearish divergence. However, the market net flow is neutral, so it's not showing any divergence. But then we also have divergences in the other major ETFs. So this is just something that I interpreted as, why is there, confusion here? And in a sense, why is this not also pointing down? Hopefully I just explained that. Is because they can be buying a ton of equity and then using the ETFs to hedge their positions. So the reason behind this is obviously the market had just had a massive rally, as we just mentioned. It closed over 2 sigma resistance last week because we actually ended up, taking off at the end of last week quarter. So we have right here, I had to bring this to your attention, right? This multi-day rally would have destroyed the put premium from May and June monthly OPEX. So I'm ignoring April because it's not enough DTE. So there's not enough days till expiration to get April puts, in my opinion. So that means institutions are likely doing what they always do, especially at the start of a fresh quarter, opening up their hedges while everyone is looking the other direction, which means I'm looking into puts for the end of May, just like a fund portfolio manager would be doing. In other words, this is an opportunity to look for some cheap puts, about 30, 45, 50 DTE, and then holding as you're hedging your portfolio if you're a portfolio manager. So as we jump along now, you guys can see how can we use that information for a trade idea. If we just skim right along, this is it very simply recapped. The visual cue. The SPY hit the intraday zone. That's it. That's your visual cue. So even if you did nothing, let's just say you woke up late and you just decided to come in and say, okay, I'm gonna just jump in a trade here, but I'm gonna wait for it to hit a level. The Quant Trading App is letting us know this is an area where there might be some sort of an inflection point. So pay attention. Maybe market will be reversed. What time were we? We were at 10:15. So just around a sweet spot. 10 a.m. would have been better, but 10:15 is a good time also to look for some sort of reversal. Then we have the absolute GEX and max pain was below spot price. So this is where we get into a little bit of gamma exposure. That's this right here. We talked about already 410 or 4100 on the SPX. In terms of the SPY, the absolute gamma strike was 407. Moral of the story is that it's down. It doesn't matter that it could have been, 400, it could have been 405, 407. That's not what's significant. What's important is that the SPY was at 411 and then the absolute gamma strike was all the way down here. So if we just jump over to TradingView, let's just turn on the Monday expiration just so you guys can see that. This is when the SPY is right up here. Your thought process is market hits here and you want to ask yourself, okay, do I want to short? Just because it hits here doesn't mean you need to jump in the short position. So we want to look for reasons to short. We can say that it is pretty overextended if we zoom out, but just because something is overextended is not, the sole reason you want to look for a short position. But look at where the market just came from. We had this massive rally, 1, 2, 3, 4, 5 days. The market rallied, and from the low all the way up to the high right here, we're talking about 4.5%. So 4.5% in a few days is a pretty decent size rally for the S&P 500. We have absolute GEX here. Let's just jump over to the SPX just so you guys can see. We have the absolute GEX at 4,100. It actually is in the same intraday level here. We have max pain is all the way down here. Now, both of these, for lack of time, instead of repeating this a million times, just think of these as magnets. If you're now starting out with gamma exposure, price is going to want to gravitate towards the absolute gamma strike as well as the max pain strike most of the time. We have enough price action history to show this within QTA. We have on the website, we can actually go back and you guys can date back all the way up until summer of last year and check every single week if you'd like to, or you can take my word for it. Just know these levels are generally going to act as magnets. It doesn't mean it's always going to go straight to that level right away. The market could have gone all the way up here and then later in the week come back down to this level if it didn't change. So you don't take it as an absolute just because it is a key level. Max pain is all the way down here. Look, we never went all the way down to max pain, but we just want to use it as some sort of a compass. We're saying that, hey, the market wants to probably head back down to these levels because that's just the way it flows certain times, just to keep it simple. Obviously, I can over-explain this. I've done webinars in gamma exposure. I've done webinars. I haven't done an exclusive video on max pain because to me, I think it's just a little bit too simple of a concept to, do a dedicated video on, but I'll probably get around to it one day. You can look it up on Investopedia.com if you've never heard of the max pain theory. As we scroll, or we jump back to this right here. So what do we have? We have the 0 DTE absolute GEX. So this is a magnet. And we have max pain was below the spot price. So max pain, as we just saw, was all the way down here. We have the absolute GEX here. We have the weekly absolute GEX was also down here. I'll just jump right along for the confluences. I'll break this down a little bit more. We have the Trading Ticks Algoflow was also bearish divergence, which is what we were just reviewing. So all this bearish divergence. Then we have the VIX is up when the SPY is up is not a good sign for bullish continuation. SPY closed above 2 sigma resistance last week. And then we have relative weakness in the Qs. So as we jump back to this right here, it's just showing relative weakness. The Qs couldn't even make it up to here. So the Qs closed here on Friday, it gapped down, and then it bounced. This is about a 50% retracement, and then it continued to sell up here. So the Qs, NASDAQ, couldn't even make it up. If you've never heard, this is difficult for the market to continue rallying when it doesn't have support from the NASDAQ. The NASDAQ tends to move, or the NASDAQ tends to influence the SPY pretty significantly, which is the S&P 500. So in this case here, you don't really want to trust the rally when you see the SPY going up like this, and then you don't see that the Qs are also breaking key levels. So that's why I just included that as the reasons, or confluences for the trade. But at the simple level, it was just this. It's just the SPY hit the intraday zone. The fact that it hit the intraday zone, then we have about 15 minutes or so to then look for some sort of additional confluences. And that's what you guys will see me doing within Discord when I start looking up, the Trading Ticks Algoflow. I start checking, other little things. How's the gamma exposure, all that type of stuff. But each of these confluences here just takes 2 seconds because it's on our chart. So we don't have to really look it up. As the SPY is at this level, the SPX is at this level, I'm just saying, hey, where's the purple level? Hey, where's the blue level? They're both pointed down. So down, down. Whereas the weekly, this is the weekly gamma exposure, but you guys know where to look at for the 0 DTE gamma exposure. That's what would be right here. So we can just check this. 0 DTE levels are also in here. So I'm just checking those things. Takes, again, less than 60 seconds or so once you just get used to or comfortable looking for the same things. So as we jump right along, this is the gamma exposure right here. This was the 0 DTE, just to show it again. So this is, we have potentially, this was to be the high of day. So we already have this confluence. This is our last resistance right here, or at least this level. So this general area. So between 411 or 412, we would think of this as the market is not really likely to go higher. If you understand gamma exposure, you'll know why. But in this case, even if you don't understand gamma exposure and you're new, just know that this purple level is pulling back and so is this blue level. So both of these are pointing down, or as I like to say, south. This now is the 0 DTE gamma exposure for the SPX. What do we have right here? It's at the absolute GEX strike, and where do we have max pain? It's pointed down. So we have a few things to think, we have a few reasons to think that the market is going to struggle to go higher. The visual cue, again, I'm just trying to reiterate that. It is as simple as this is where we were. We were in this level. It was just the fact that we were here. All this information right here. SPY hits this level, the SPX in this level. I'm looking for reasons to open up a trade. Outside of that area, not really that interested. I found a few enough reasons to decide to run some sort of a trade. So what we have right here, this is a 0 DTE at the money iron fly. I'll jump back to this in a second. We'll review this because this wasn't relevant. This is just an example to show you guys that you can run this on any day, but just to draw down to expect on days which we don't have the confluences. I'm going to jump forward now to the Tuesday. This is also showing you guys an example within QTA. You guys know, or I already shared this. I was just saying that this helped me not hedge too early. So if we take a look at this right here, the SPX on Monday was at this level. I'm in a 40-something DTE iron butterfly, and I wanted to know if I wanted to adjust the trade, either widen the iron fly, open another butterfly, just reduce my delta. But the reason or the trigger I was using was if we broke and held over that level. The fact that we rejected at this level meant I didn't need to make an adjustment for myself. So in this case here, that's what I was pointing out right here. So it was also happened to be the break even on my iron fly. So that's all that was here, and this is the iron fly in which I'm currently in. Moving right along now, let's jump to Tuesday. Okay, now as we zoom into Tuesday right here, what do we have? We have the SPX gaps up slightly, just over yesterday's high. But what clues do we have? We have absolute GEX down here again at 410. So this is the SPY. It's 411. It's 4100 on the SPX. As we'll take a look at in a second. We have max pain. It moved up, so it was no longer at the 400 level. It moved up to 405, but it's still very far down, relatively speaking, of course. What clues or what reasons would we decide to open up a trade here? So if we scroll forward, let's just jump to take a look at the absolute GEX. This is something I came in later in the Discord and mentioned because I myself actually did not take this trade, and I was kind of upset with myself for missing this as I tried to run a non-directional iron fly on the SPY and then ended up getting myself into a little bit of trouble. But this is, again, the point of me making these videos is so you guys can form your own conclusions and not just copy exactly every single trade in which I post, because there won't always be the time where I can share every single trade that I see. I can do my best to try to educate you guys on this information, how I digest it, how I use it, and then you guys can formulate your own conclusions using your own risk parameters. But what we have right here is the SPY similar situation. We have, where's absolute GEX? It's at 410. Where is max pain? It's at 409. So both of these are pointing, as I like to say, south. So if this is the SPY is all the way up here, or the SPX is here, this is south. This is south. That's the way I see it. If we're talking about which way is north, this is north. This is our positive gamma strike up there at 414 in Quant Trading App. We call it P1, the highest positive gamma strike. So as we move forward, we have one indication south, second indication south, right? Move right along. This is also the 0 DTE. So this was the 0 DTE on the SPY. So 0 DTE SPY right here. 0 DTE SPX, what do we have? We have south and we have south. So we have south, 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 south. Four things pointing south that tend to act as magnets. Continuing right along, let's take a look at where did the SPX, let me just scroll down and see. We have a few gamma exposures. Before we get into exact trade ideas, I think this is what I end up sharing in Discord here. So yes, so this little breakdown. So this was to help you guys, because as you guys know, I was typing a whole lot this week, trying to answer as much of you guys' questions as possible within the Discord, and it got pretty, my fingers started hurting. So I was like, if I could just talk to you guys like how a coder would, it's pretty easy. But this right here is the logic. So right here, we have relative to the spot price at the open from pre-market, 0 DTE max pain was pointed down. Weekly max pain pointed down. 0 DTE absolute GEX pointed down. Weekly absolute GEX pointed down. So which direction do I think we're going? Down, if we're just basing it on these. Now, obviously, this is not the only reason to take a short trade. Guys, please understand this. I know some of you guys learn about gamma exposure, you learn about max pain, and all of a sudden you think you throw away everything else, you throw away everything which you learned, and you're just like, oh, it's going that direction. If it doesn't go that direction, it's just like, oh, everything's broken. No, it doesn't work that way. Nothing is 100%. We've just been seeing tremendous accuracy this year with the gamma exposure, especially relative to last year, because the market is not as net negative gamma as it was last year. So things are kind of returning to a state of normalcy, even though the market is still experiencing a lot of volatility, traditionally speaking, largely probably because of the zero DTE options. And then we're still not necessarily out of this quote unquote bear market. Now, as we continue right along, where did the SPY come from? Is it extended? Yes, we can still make the argument that it's extended because we're continuing the narrative from last week. The market closed over 2 sigma resistance. So then that's what we have right here. So is the put butterfly within great risk parameters? So this will review the actual trade, and that's what is this right here. So if we scroll in, this was the 4090 put, right? So why that put? To make this easier to see, let's actually, did not mean to do that. That might be a little bit confusing. Let me just drag this over here and let's go to the next day and minimize this right here. And now we have the Tuesday, right? So as we scroll in, this is the day we're talking about. What do we have as absolute GEX? This level right here, 4100. And then we have the reason 4090 was mentioned is because if we scroll back up, where are our zero DTE gamma strikes? We have 4090. So 4090 is our max pain, and we tend to think of max pain can potentially be a target. So if the SPX is all the way up here and we're thinking, hey, where is it going to go? Maybe it's going to go to max pain, maybe it's going to go to absolute GEX. It doesn't matter, split the difference. You can go at 4095 if you care for, you can go at 4100, you can go at 4090 for your butterflies. It doesn't really matter. I tried to show that as an example later here because the question, and I think one of you guys are asking was, well, why did you go with the 40, why that strike price? Why 4090? And I made sure to put that in the title here. It's just the zero DT max pain. So in this case, both the zero DT max pain, the absolute GEX, they're all pointed south. So maybe I'm thinking it's going to pull back. But again, it's not just that in isolation. It's the fact that the market closed over 2 sigma resistance last week. I don't really think it was going to go higher this week. That's the main concept here to hopefully understand, guys. It's not just because. And I know in the Discord I'm going to hear this, a couple weeks down the line. It's just going to be, oh, well, why didn't we go with max pain this week or something? Is, guys, the market just rallied 4.5% in 4 days, 5 days. It closed over 2 sigma resistance. It only does that maybe 4 times a year. That just happened last week. We know after that happens, it tends to be a doji candle on the weekly time frame for the next week, or it tends to have some sort of a slight pullback. That's what's more likely to happen. But what usually happens is reduced net change. Knowing that, we can say, hey, the market already went up to start the week. As we already saw, it did that already. It already made this push. We can say that, what's the chances of us going much higher? Based on our data, it's less likely to go higher. So we're looking for reasons to short. That's why. It's not just because absolute GEX is down here, max pain is all the way down here. It's not just because of those reasons. It's because of this larger thought process carrying over the information. Now, if we take a look at this butterfly, risk reward is the next important thing with trading. Once you have your trade idea, you want to have your conviction. You have your thesis, but you want to have your conviction. You want to have good risk reward in the trade you're structuring. I love butterflies because you get these asymmetrical returns. You're using very little capital to potentially make a ton of money. So in this case here, the spread hit a low. I shared this is straight from the Discord, but the spread hit a low of 258. So the max drawdown on a $325 position was 67 cents, which is a minus $67 if you bought 1 unit. So it's about negative 20% or so. But the opportunity was, if this strike price was to hit, which it ended up hitting, it made over 250%. That's an amazing risk reward ratio right there. Then if we take a look at, this is later in the day, obviously, if you're still holding until this late, you have potential to make over 5, 6, sometimes 700% return. If we take a look at on the right-hand side right here, this is the P&L curve or the price history for the spread from entry. So we're just talking about if at the open, 3 minutes after the open, you decide to get in this trade, you're not really experiencing much drawdown. This is a little bit of the drawdown here. Might have happened about 30, 45 minutes later. And then we can see that the P&L was just completely green for the entire duration of this trade after the first 30 minutes or 45 minutes or so, and the drawdown was not that bad. And that's something that's pretty important psychologically. You want to track how deep was the drawdown for your trade. Even if you open a trade like this and you close it out early because you were scared or you're afraid or whatever your reasons are, take your notes like this. I take notes all the time, and after I close a trade, if I close it too early, this is how I have enough information for the past years of doing this that I know which trades are the ones that I'll want to hold a little bit longer because I know the opportunity that's there. I know what I'm risking also. If you don't track this and you don't know what type of potential you have, how long you generally might need to hold the trade, those are things that they're going to shake you out. These are the type of trades that you want to just enter, set an alert for the price of the spread itself. You can do that on Thinkorswim. So if you get filled at 320, you can set an alert at $2 to come back and check to see if it's going wrong. But then maybe you come back and check in the middle of the day, or you check during power hour, and you kind of see. Sometimes for some of you guys that are a little bit more nervous about some of your positions, it might actually be better for you to walk away after you've opened the trade, as long as you set your alert, know what you're risking. If you have a $10,000 account, you can obviously trade a $3 spread here. That's not really going to take it would take a lot, in other words, for this to suffer for a 50% loss or so. So you're risking less than $160 on a trade like this, and you have opportunity to make a ton of return. So if we continue right along, this now was the 4100 butterfly, because one of you guys asked, again, this is the 4090 butterfly. One of you guys were like, oh, why the 4090? Why not 4100? Because 4100 was here, and I mentioned Max Payne 4090. You were like, why don't we go with Absolute Gex since that's 4100? Yeah, you can do that too. The point of what I was trying to make is it doesn't matter. This one also worked just as well. The drawdown wasn't really that bad either. It must have been about a 60 cents drawdown or so if you got filled around $4.50, if you got filled around $5, anywhere in this vicinity here. The point is, you're thinking the market is going to pull back. Why are we thinking the market is going to pull back? Because of the aforementioned reasons. Where is Max Payne? Where's Max Payne? Where's Absolute Gamma? Where did the market come from? Do we still have divergence on trading ticks? We still have the same reasons from the previous day. All that is carrying forward from Monday. So all that information carried forward from Friday into Monday into today. So we have multiple reasons to think we're going to experience some sort of a pullback. So that's why I just mentioned this. Just have this type of logic. Which way is everything pointing? Oh, down. Should you run the trade? Yes, because everything's pointing down. But more importantly, great risk reward parameters. So if it didn't work, how much would you lose? How much are you willing to risk? About 50%. How much would you make if you're right? At least 200%. If it pinned, which means it closed exactly at that strike price, over 500%. Should you run the trade? Yes. Just yes, 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 yes. At the same time, how many units? This is my personal. How many units would I want to run? 2. No more than 2. Why 2? 2 would have cost around $650. I don't like risking over $300 to $500 in 0 DTE, especially on just one specific trade. So in this case, for this one trade, I would not risk more than $300 to $500 for my own personal risk parameters. That's what I am comfortable with. And then 2 contracts would leave me room for a 50% stop loss. I'm going to give it a pretty wide stop loss because there's enough conviction to think this trade is going to work out. So I don't want to stop myself out of the trade too early, and then just run the trade. Set an alert on the spread if it drops below 30% as a warning to see if I should do something, and then set an alert or set a limit sell order to lock in the profit at 100%, and then leave 1 as a runner, because then it significantly reduces the risk, and that's how you can get an extra 400% or 500%, sometimes 600%, as you guys have seen happen occasionally. Run the trade. This is kind of the formula to have in your head. You have your, we'll call it macro reasons, and then we have some of the intraday reasons here, and then we have great risk reward, because it means if you took this trade, if we saw these exact same conditions here, and you took the trade 4 times, and it lost every single time, but then the 5th time you run the trade, it means you're either going to be some sort of break even, or you might actually make money. If you take a 30-40% stop loss or so, you can take this loss many times, but you're not going to have such a low win rate, because this is actually our edge. And that's what you want to have, and that's what we have within QTA. There is a significant edge here. It means if the trade does not work, so what? Your position size, you should know what you're risking. It's fine. Take the trade. You lose the money. It's okay. You move on. Next time you see the same conditions, you take the trade. You see it work out, it more than cannibalizes on the previous loss, and that's just trading, especially when you have great risk reward. As we continue along now, we can see that I think I pointed out this example right here. I said this was with 25-point wings, targeting 4100, but then to paint the picture here, this is with 50 points. Let's just see what we have right here. Again, just different examples. I won't spend time on each of these because these were shared within the Discord here. This is the 4100, so this is with 25 points wings, I believe, and then this one we have right here. This is with 50-point wings, so a little bit larger size, but this has a higher probability of winning because you have such a wider profitability zone. You guys can see how this ended up working out here. But then this is something that I wanted to point out. This is targeting 40.50. So this is a strike price that's pretty much, you know, all the way down here. So it's not even a strike. I have to zoom out. So this is targeting all the way down here, pretty much max pain for the day. This is an insane drop. There's no reason to think that if you're opening this trade here that the SPX is going to drop all the way down to here. This would be a almost a 2% drop, so about a 1.9% drop in a day. That's kind of, you know, shooting for the moon. That's kind of, you're really reaching it. That's not statistically probable, not very likely to happen unless we had some sort of catalyst, unless there's some sort of, you know, major news that would have caused that to happen. However, it doesn't stop you from still having a great trade. If you have a tiny account, you know, we're talking about a $2,000, you need at least a $2,000 account to have a margin account on Thinkorswim. A $3,000 account to me is what I consider a small account. Anything between $2,000 to $5,000 account, you're gonna have, is gonna be in the small account size for margin for spreads, and that's what we're talking about here. These are butterfly spreads. But even so, this is a 10-cent spreads. If you can, 13 cents. If you could happen to get filled, the problem with this is it's going to be a little bit difficult to get filled. But if you can get filled on something like this, which in this case the SPX, thankfully, the past year and a half has had tremendous liquidity. Completely different to how it was before 2020. Even 2020, it was not as easy to get filled these types of trades on the SPX. But before 2020, forget it. You would have been sitting there probably for an hour trying to get into some sort of spread like this if you ever got filled. We don't have that same problem today because there's so much more traders trading the SPX. A lot of retail traders that don't really know what they're doing are trading these 0 DTE positions, and it's making us have tremendously great liquidity. So we can get filled this type of stuff. But to show you guys, this thing went from 13 cents all the way up to $2.40. Now, you don't need to hold until the close. This is just a trade for you here. So if you're in 3 of these or so, you're talking about a position size of less than $40, less than $50, we'll say. And then we're talking about a return of over $500, $600 on a position size that small, which is insane, but that's the type of, you know, market in which we're living in right now. This is deep out the money. Did I think the you know, the SPX was going to go to 40.50 that day? No. Would you think it's going to go to 40.50 that day in one shot? No. It's if you're thinking that without a catalyst, then, you know, I don't know what your win rate is like. This, you might get lucky once every 20 trades that might actually happen without a catalyst. But, you know, this is just something to take note of. You can trade a butterfly all the way down here, and all it takes is the SPX to go from here to here, and you're talking about a 500, 600, 700% return, even though you're nowhere close. We're talking about the SPX stopped around 40.88, 40.85 or so. That's the low of the day, and you still ended up having a return that large. So guys, don't get so hung up on what your short strike is, or, you know, what your puts, you know, how you're structuring the butterfly, all that type of stuff. No, that's not what's really important unless you're focusing on pinning. But I wouldn't suggest you focus on pinning. First, just get into a good flow of understanding this information. Try to understand what's the likelihood of the markets being within a certain area throughout the day. That's kind of all you need. We don't need the markets to go all the way down here and pin. We just need to know that maybe it's going to be below this level later in the day. It makes it a little bit easier. You're creating a much larger target for yourself. That's kind of the thought process you want to have to increase your win rate. So this is a deep out the money, 25-point wide, 0 DTE, 40.50 put butterfly, targeting no realistic strike, and look at the returns here. So something to take note of. I shared this with you guys. This is the kind of trouble I got myself into. It was kind of a dumb trade I opened at the open here on the SPY. I actually didn't end up opening a 0 DTE SPX trade, but this was, you know, relevant for this video, just showing some of the positions in which I was in. I was currently under the water, but I was actually able to make my adjustment a little bit early in the day once I took notice of how low we were likely to go. But I was pretty confident that we weren't going to go any lower, just because of my own discretion, as well as looking at the gamma profile and things like that. But again, for the purposes of this video, not really that relevant, but just to show you guys, I actually did not take this trade. I ended up sharing it after the fact. The market still was not closed. I don't remember what time I shared this within the Discord, but I was saying that I was actually upset for missing this, and this is why you don't want to just be dependent on exactly what types of trades I'm taking. This is the logic here. As long as you're aware of this, you can catch these types of opportunities even before I actually even end up seeing it, because I'm traveling back and forth between East Coast, West Coast. The time zones are throwing me off, and it's very early for me. Right now I'm on the West Coast, and that's essentially one of the main reasons in which I was not fully clear on what I wanted to do on this day, so I ended up missing out this opportunity. By the time I took notice of it, I figured the risk was a little bit too high to open up the type of butterflies that I would have wanted to run for the 0 DTE ones. So what we have right now is Wednesday. As we jump forward here, what do you have? This is becoming the bread and butter at the money 0 DTE fly at the open. So I'm not going to spend that much time on this. It's very self-explanatory. It made me very excited to see that you guys are finally starting to catch on to this setup here. Some of you guys are taking it. Some of you guys are holding it all the way into the close and getting your pin. That's amazing. Congratulations for being able to hold through that long. I hope you guys are not holding the full size. If you're in two of them, I hope you're taking profits early in the day. Holding a runner, I hope if you're trading the SPX, you're locking in profits on the XPX and then moving over to the SPY. But to break this down for you guys watching this on YouTube, this is something that we look for. So if this is the pre-markets 0 DTE, so this is at 9:15 Eastern time, so 15 minutes before the market opens, we have the SPY. This is the spot price for the SPY right here, so it's around 408. We have max pain and we have absolute GEX. We can see both of them pointing up, but the moral of the story, or the point of this, is that they're all kind of clumped together. Whenever they're clumped together like this, especially when we see like negative, positive, negative, or we see, in this case, we have let's make this here. We have these two big blocks right here, and then we have a couple big blocks right here, and then we just have this space in between, and the SPX or the SPY is right here. It tends to be pretty choppy, right? So if we jump to the SPX, what do we have? We have max pain here, and we have absolute GEX here. The SPX is in between. We have a lot of indecisiveness. We have negative GEX, positive GEX, negative GEX, positive GEX. All this tends to lead to choppy price action. We love to see this when we trade butterflies. This is an example of running a at the money iron fly. So as soon as the market opens, the 40.95. So if we jump to the SPX for the next day right here, this would be the Wednesday. We can see where did the SPX open up. Right here we open up and we see the strike price on this right hand side right here is about 40.95. So that would have been the closest at the money strike. Just running at the money. I happen to use 75 points. There's no particular reason. I just like 75 points. I have templates in Thinkorswim, so I'm able to just trigger, submit this order pretty quickly. I set my stop loss or I set my profit target depending on the day. If I'm scared, I'll set the stop loss in manually. If I'm not scared, I'll just set it as an OCO order. There's all sorts of different templates you can set up within Thinkorswim. But this right here is a 0 DTE at the money fly, and it means as soon as the market opens, I'm in the trade. I'm targeting about 3 to 3.3%. Some days I'm more nervous than others. 3 to 3.3% just seems to be how I can be very consistent. I've yet to lose on a trade like this whenever these conditions are there for the year. So whenever we see this on the SPX and the 0 DTE and the SPY on the 0 DTE gamma exposure, I'm in there as soon as the market is open. And of course, if I have Thinkorswim open, there have been days in which I've been about 3 or 4 minutes too late, and then I don't want to end up running it, so I just track it for data purposes. But in this case here, just sharing that with you guys. If we were to look for a little bit more of a breakdown for the trade, this is it right here. Again, at the open, that's the at the money strike price. I'm just shorting at the money put, shorting at the money call, and then just buying 75 points up that way, 75 points down that way, turning it into what's referred to as an iron fly. Usually within 6 to 10 minutes, I hit my profit target, which is about 3% return on my capital. So if I'm in two of these, it tends to be when the VIX is a little bit higher, I'm usually getting about $250. Now you're generally going to get around $210, $212 or so if you're holding out for about 3.3 to 3.5%. In this case here, you can see in about 6 minutes, profit target was not essentially hit, but I was already out. I didn't really want to hold much longer. 7.7% return on the credits, but we base most of our credit spreads, the return based on our margin. So our max loss, it's just a good way to have a standard or a uniform way of tracking your P&L. What we have right here, this is just showing about 30 minutes later, returns about 5.2%. So the journey of this trade is just to show you guys, this is what we're looking at. So generally when you open it, right at the open, if you get in at the money fly, obviously you have to be pretty quick if you're getting in within the first 30 seconds or so. Anything within 30 seconds, you're pretty quick. I've gotten filled within 10 seconds at times. That's, again, when I'm using my templated orders, I'm just right-clicking and submitting pretty quickly. And so those are days when I'm really, really sure, or I have, a decent amount of buffer or risk for the week. But just to show you guys how quick the P&L is hit, we're shorting the at-the-money call, at-the-money put. This spread benefits from the drop in price for those options because you're selling these options. We can see that the drop in price in these options here, this is at 5 minutes later. The spread is already at $187. This is just a screenshot straight from Thinkorswim. You can actually put the spread within Thinkorswim right here and track the P&L for it. And then you can see how long you have to hold to get that extra, squeeze out that extra little bit of juice. So if you're aware of this, that's why sometimes I generally just take my profit within 10 minutes instead of holding for this, because you have a lot of risk out on these trades, and it does get a little nerve-wracking to hold, especially if you see it go back up to, you know, the opening price, which happens every once in a blue. It doesn't happen again whenever the setup here is, again, whenever it looks like this. That generally does not happen. Not to say it won't. So you just want to be aware of that. So that's why I make my decision, and you guys will see me close pretty early because I don't want to be sitting in the trade all day. In this case here, it wasn't until later in the afternoon, it actually, or later in the morning, just before lunchtime, you guys can see it actually broke, and then the trade did go red for a bit, but the max drawdown was only $142, so not too bad. But it would have been scary to obviously see. So that's why it gets a little nerve-wracking. You don't want to hold these things, you know, all day long. But obviously by the end of the close, the SPX ended up closing right around where it opened. So it would have been a huge return. This is the same chart here, but now I'm just showing it with the candlesticks. So this would have been the open, same price, you know, 21.51. It's just the same information that you guys are seeing here, 21.51. This is just the line graph. So this is plotting the closing price of the spread every minute. I believe this is a 1 minute time frame. So every minute, this is the closing price of the spread. And then the same thing here. This is the every minute, but this now is a candlestick chart. So we're getting filled around here. And you guys can see how fast the profit target was hit. And then if you wanted to hold, this is 7 a.m. Pacific time. This would be 10 a.m. Eastern time. So 31 minutes after the market was open. So hopefully you guys can get an idea of that. And that's why I believe I said I was going to skip over. If we zoom out, we're almost through. We only have one more day to go over. But that's why I said actually I was going to skip this day here, because this was on the Monday, which was a day in which these conditions were not there. It was not a good day to run an at the money 0DTE fly, but I wanted to show you guys just to as an example. As soon as the market opens, which was 4,100 as we went over already, if we zoom out again, let's see here, this was Monday, just to confirm, yes, right here, the markets, let me go to the SPX. We can see that the SPX opened right here, 4,100, right? So let's just say you decided to run an at the money fly. Boom, market opens, and then it just looks like your account is just blown up because the SPX just rallies. Boom, it rallies 25, 24 points, whatever, 30 points almost. You're going to be nervous. You open this position here, and the SPX just goes straight up. That's going to make you sick to your stomach, but how bad of a pain? So 9 minutes later, you're down pretty much how much we're usually hitting as our profit target, which is in this case $145. Not too bad. Now, 30 minutes after the market opened, this position is down $350, so you're down 6.6%, almost 6.7%. So I'd rather just take that $2 stop loss per unit, the $3 stop loss per unit, depending on how things look. I'll let discretion take over. There's no shame in that at times. But then as we take a look here, this is 24 minutes now after this. This is the lowest point this P&L, this position would have been down, which is 16% of margin, which is a huge drop, but that's $840. Again, we're basing it on one unit. If you have two, that's a pretty decent loss for the day if you realize it. But then we're talking about just a few minutes later, it's back to break even. So 1 hour and 17 minutes after the open. And now just 4 minutes after that, the target is hit. So $200 or 3.8% return on margin in this case. So 1 hour and 21 minutes after the open. Now we're talking about another hour passes by. Now this position is up $650. So 12% on margin. And then by 2 hours or so before the market closes, this is the most amount of profit this position has seen. A 22% return on margin, which is about 51% return on credit. So $1,150, about 50% of this right here. And this is what the P&L looks like. So just showing you guys some information, some data, so you see, even though this is pretty bad here, this is you don't want to experience these types of drawdowns unless you have some sort of tremendous cushion. You've been in a flow for a couple months, and you have, you can kind of hold these things a little bit longer to let them come back to life. But again, drawdown here, it came back to break even not too long after the market was open, less than an hour and a half or so, and then the position hit its profit target right around here. And then you guys can see around 2 p.m. Eastern time right here, about 2 hours before the market closed, you're talking about 1,000% return. And that's a day in which the conditions were not poised for it. It was not a good day to run this, but the market was choppy. Now, obviously, if it broke the intraday zone, then I would not hope for this thing to come back down here. You're in trouble. Once these zones breach, The likelihood of it closing back below it is not very likely once it's to the upside, especially if VWAP is rising, but I've gone over that in previous videos. So we close this out now, and let's jump to finally the last day in review, which would be Thursday. And as we zoom in here, we have Thursday's price action. The morning session, pretty choppy, right? So what do we have? Let's jump forward to the next slide here. Week opened at 4,100 and it ended up closing at 4,105 as we spoke about earlier in this video. But so now we're looking, this would be the 0 DTE SPY GEX. So from pre-market, what do we have? We have our setup. This is the spot price. It's not identical in this case. We didn't have like max pain here and absolute GEX here, but it's the setup in terms of the proximity for the spot price for max pain and absolute GEX is pretty tight. So they're all clumped up together. In this case, it could have been 406, could have been absolute GEX. 408 could have been max pain, spot price could have been 407. We just like to see a nice clump of them together, and that's what we have here. And then we also want to see some sort of support. So support in terms of we have a big negative gamma level here, and then we have a big positive gamma here. So this is what we can think of price will ping pong around for the opening session, or at least for the first 30 minutes or so when I say the opening session. And then if we jump to the SPX 0 DTE, what do we have is this was the spot price. Again, this is 15 minutes before the market opens. So we know the spot price for the SPX is not accurate pre-market because it's based on yesterday's close. There is no pre-market trading for the SPX. But what we have is the spot price from yesterday is in between this absolute GEX and in between this max pain. We can kind of come up with an estimate for the SPX will be at the open just based on wherever the SPY is. So if the SPY is at 406, you can do a little bit of math and say 406, just add a 0, then add maybe 13 points or so, and that's going to give you about 40.73 as an estimate for where the SPX might open. I don't do this math. I know I'm going to run an at the money fly. It's just the way I'm thinking about it. The setup is there, and sometimes I try to base that formula, but I'd rather just wait as soon as the market opens to get that actual open in print for the SPX. What we can see right here is this is what's pretty important. We have an idea. So this is something I broke down within the Discord because you guys had some questions about this also. If the SPY is like this, why isn't the SPX exactly matched? The SPX options chain and the SPY options chain are two completely different things. They're two, the SPY has a ton more liquidity and volume. The SPX has a ton more strikes. So these strikes are going to divide up the volume. If there's so many, if there's so much more strikes here. We have 405, 410, 415, 420. Every 5-point increments, whereas the SPY doesn't have the same amount of increments. So these strike prices are going to be broken up a little bit more, but that means we can get a little bit more of a zoomed in view, and this is going to provide more of a framework. So we can say, 40.60 is probably going to be some sort of support, and 41.10 is probably going to be some sort of resistance level, or these are going to be our inflection points. A break below this level is going to be strange, and a break above this level is also going to be a little bit strange. So that means a break below this level, maybe we're going to enter some sort of, trigger down with volatility will just start picking up and the market might sell off drastically, or break above this level might have some sort of gamma squeeze if we start seeing gamma growing at higher levels or so forth, as we'll take a look at in a second. But for the opening, we're going to think about this as this is potentially going to be where the market might get stuck. If it breaks over this level, that's going to be strange or interesting, but then we can say maybe 4,100 will be the new support, and then the market will likely rally to the next high gamma zones, which would be 41.25 in this case, 41.30. I think last week Friday I actually reviewed an instance of that. But as we jump forward, this is the at the money fly. So 40.80 is where the SPX actually opened up. If we take a look at it for a second here, this would be 40.81, 40.80. So we have, this is what it looked like. So we knew 4100 is a powerful level. We have max pain right down here at 40.60. And within, this was by 10 a.m., the spread hit, 4.7% return. In this case, I did not get filled. I shared the trade about a minute or so after, 2 minutes, I believe, after the market opened, just letting you guys know I didn't get filled. But then I was so happy to actually see a couple of you guys actually were like, you're already in it. You got filled a few of them in the SPY. That's amazing to see because it means you guys are learning. You didn't wait for me to say I was going to be running this trade. You guys already knew what the setup was. You guys were able to identify this and see it and say, hey, you're going to take the trade or take the risk for yourself. That's what's important. You want to be thinking for yourself. I can't stress that enough. In order to be successful as a trader and have longevity in the market, you need to be able to derive at these conclusions on your own. You can't be sitting around waiting for somebody to tell you what to do with your own money or what they're doing to try to copy it with it. You're not going to have the same conviction. You're not going to understand what they're doing. And it seems that it's finally starting to click with some of you guys that you're understanding why these decisions are being made. And that's the point of why I'm sharing these longer videos or breaking down every single day so you guys know what I'm thinking pertaining to certain things. So it'll get to the point where you'll be able to hear my voice without me even saying it. So we have a 0 DTE at the money fly, profit target hit. This case, I missed out on it. I didn't get filled. Some of you guys were in it, were able to get filled. Amazing. But as you guys can see, I still ended up tracking the trade. I just wanted to get an idea of how it worked that day. It ended up hitting by 11.23, about 12% return. So this was amazing. Just trying to see, I'm tracking this pretty much every day in which I get the chance, whether I run the trade or not, to kind of get an idea for the future whenever the VIX is at certain levels for what type of strategies I want to run. As we move forward right now, I wanted to bring this to your attention. So this is now 11 Eastern time. Pay attention to this. Look at where the blue in the background is the volume. So this is call volume. The orange light peach or so is the put volume. So we can see a decent amount of put volume at 40.70. The highest amount of put volume was out here at 40.50. And the most amount of call volume, so almost, what is this, 28,000, we'll say, call volume is going to 4,100. And we can see this absolute gamma strike, and it really held up. Even as the SPX had sold off a little bit early in the morning, it didn't sell off that far as we took a look right here. It didn't really, sell off that drastic. But now we're talking about right here. This is 11. So just before it breaks over the anchored VWAP. We're seeing a lot of call volume going into this level. We're seeing a lot of positive gamma. This is kind of an indication that, price looks like it wants to go higher. There isn't really that much negative gamma between here and here. So at least 40.95 is something to think about. I ran, if I remember correctly this day, I ran a twin fly, as I like to call them. So I ran and 0 DTE butterflies targeting both of these areas because I wasn't sure which way we were going to go. And I figure I'll just let price ping pong around those levels here. Let me actually see if I can find the position in which I was in right about here. So this was it right here. So this was the twin flies, just so you guys can see. So 40.60, 40.95. Should have went with 4100, but I didn't think, this was early in the day, so that I ran this. When I didn't get filled the 0 DTE iron fly, I decided to run one of these about 10-15 minutes after the market opened because I didn't want to miss out on some of the choppy price action earlier in the day. And this is where I got my targets from, 40.60, and I went with 40.95. So those two, I didn't want to go that far out because at that point it looked like the SPX was going to hover around more so this area earlier in the day. But now, as we can see, ton of positive gamma. As we move forward now, this is right before we break. So what do we break? We get back over max pain. This is the SPY, by the way. So the SPY's max pain, the SPY's absolute GEX was at 407. We're over the 2-day anchored VWAP. We have this little bit of a technical level here. So we have technical levels, we have some gamma levels, and then we're seeing the interest growing. Then we also have, if we go back to the beginning of the week, we knew the net change was going to be pretty narrow for this week, which means the SPX is going to want to close. The SPY SPX will probably want to come back around this area, wherever it closed from last week, because wherever it closed from last week, within this area here is going to be a small net change. Now it could have closed, down here, and that would have still been a small net change relative to how volatile the SPX or the SPY has been lately. But the thing to take note of is it might want to just go back to here and close out as a doji, because that's what we've seen. Dojis tend to happen after weeks when the SPX closes over 2 sigma resistance. So if we come back to this chart right here, if you're a momentum trader or a 0 DTE long call option trader, you don't trade spreads, this is an indication maybe you just look to take a deep out the money call or something like that, and this trade would have worked out pretty well for you. So just something to take note of. This video has already exceeded the time that I wanted to talk about some of these days, but I encourage you guys to, within QTA, go back to this day, go back to April 6th on the data page so you guys can come down to this right here, go to the archive GEX graphs, jump back to that day, turn on the 0 DTE so you can load up the 0 DTE, just click this right here, check out the SPY and the SPX, press submit, it will load up all of the graphs for you as well as the chart on the SPY with the candlesticks, and then you can actually review, and then you can kind of click through each day, each 15 minutes and see what ended up happening as the gamma was growing while the SPY was down here, what was happening up here, and that's a good little exercise for you guys. Now to conclude, let's just take a look at a few spreads. Sorry about the abrupt conclusion, guys. I just figured the video was getting a little bit too long, and I'll just separate the information I was going to show into another video that can be a little bit shorter. And I just wanted to point out again, this was the recap of the SPY here, but I also forgot to mention that this was the QQQ. So the NASDAQ, we can see that on Friday, it actually hit the buy zone. So that was also a little bit of a reason to think that the SPY was probably not going to sell off a little bit more, as we were talking about reasons to think that the SPY would have rallied back to the weekly midpoint, or the SPX would have rallied back to 4,100. We're just using the confluence with the SPY. Hopefully you guys enjoyed this video. Look forward to more weekly recaps, and links in the description down below to Quant Trading App as well as the Quant Trading App Discord. Thanks for watching, guys, and I'll catch you in the next one.